Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is another update on monetary trends around the world. This month, which is March 2018, I want to focus on only one country. It's an important country, the United States, where I'm going to argue that current monetary trends are a little bit worrying. I wouldn't get too hysterical about it, but they're a little bit worrying. You can see from this chart, which shows the growth in the last 3 months, but then at an annualized rate, assuming the last 3 months carries on for a full year, the 3-month annualized growth rate of M3, broad money. You can see it's falling. In fact, the last 3 months, the 3 months to February, was actually only 2.0%. Now, in the long run, the rates of growth of real money and real output are very close together, not identical, but they're very close together. And in the short run, the growth rate of real money is very important for the behavior of demand and output. I would just put it to you as a pretty good guiding principle that a sharp acceleration in the growth of real money signals strong asset prices and above trend growth of demand. And conversely, a slowdown, a marked slowdown certainly in the growth of real money, tends to be accompanied by asset price weakness, possibly falling share prices, and demand weakness, possibly sometimes recessions. So we've got here this dip in money growth, and we've also got some increase in inflation, not dramatic, but overall in the last, say, 6-9 months, the growth of real money in the USA has been about nil. And of course, we have had in the first few months of 2018 rather weak stock markets. Now, what I want to do in the next 15 minutes is to develop two main themes. The first one is to discuss which measure of money is really important to the economy, the so-called which aggregates debate, which aggregate really matters to economic activity and inflation. And then I'm going to explain why what's happening in the USA at the moment is worrying for late 2018 and early 2019. Now, I've spent a lot of my career on the first of these issues. Which measure of money, which aggregate, is the most important one for the economy? And I've always said that the key one is one that measures all money balances. I've never looked at so-called narrow money, measured by M0, M1, even I'm now in America, M2. These are all, in my view, very misleading. Every money balance matters, and we must look at an all-inclusive measure of money to get messages for the economy. These debates have been going on a long time, as I said, and we refer you to the book I brought together in 2011, pages 350 to 73, where I set out the explanation for the importance of broad money as opposed to other measures. And let me just say here, I think at the moment we in Britain do a very good job, the Bank of England does a very good job at something called M4X. Includes all bank deposits held by genuine non-bank private sector agents. There's some complications I won't go into now, but in my view that should be called the quantity of money. Forget about M0, M1 and so on. That's called the quantity of money, and all central banks should prepare a money aggregate in the same way as the Bank of England prepares M4X. Now, why is it that narrow money measures are not satisfactory? The problem, just think about our bank deposits. We have some money in current accounts. We have some money in deposit accounts. In America, they call the current account sight deposits, and then they have time deposits and savings deposits. If you're running a business, if you're running a portfolio, all those money balances matter. You think about them together. You don't think simply about only the current account or the sight deposits. Now, in M1 in America and elsewhere, What's included is the note and coin issue and sight deposits or current accounts, that's all. Now it's obvious that the relative size of M1 and then the sight deposits, the current accounts, can change relative to the time deposits or the savings deposits. That's obvious. We can switch between, just make a transfer between one type of deposit and another. It's also obvious that that transfer is not spending on goods, it's not invested in assets, it has no effect on the economy. Money transfers have no impact on aggregate demand or on asset prices. They are not relevant to the economy. All right? But from time to time, you get changes in interest rates. You get changes in interest rates on sight deposits. Well, actually, often they pay no interest at all, so that M1 includes mostly non-interest bearing money, whereas interest is paid on savings deposits and time deposits in Britain, deposit accounts and so on. And when interest rates change a lot, the relative attractiveness of the money in M1 and the other types of money alters dramatically too. So when, for example, you get a big rise in interest rates, then suddenly interest rates go up on the savings deposits, on the time deposits, and people shift away from M1, which goes down, into these interest-bearing deposits. The shift into M1 is simply a money transfer. It doesn't necessarily mean anything for the economy. We must always look at an all-inclusive measure of money before we do macroeconomic analysis. What I want to do now is to show you some illustrations of how badly wrong very influential and important economists have been by looking at M1, and I want to focus on the USA, which is where my current presentation is looking. And I'm going to ask you to look at this chart here. It goes back quite a long way. It goes back to 1960. It shows you the annual rate of change of M1 and the rate of change in the last 3 months at an annualized rate. Okay, both those measures of money. I want you to look, just in this first example, at 1983. I think you can see there that there was a surge, a big jump in M1. Why was that the case? The answer is that America had had an episode of very high interest rates in 1979, 1980. Volcker trying to get inflation under control. There was then the third world debt crisis in 1982. America cut interest rates very sharply. And so you had this pattern of suddenly the time and savings deposits were less attractive to hold because interest rates came down very sharply. There were money transfers into M1 and M1 soared. Now at this time, Milton Friedman was very influential in America. He'd been behind, in intellectual terms, as a sort of advisor and as a thinker, behind the changes in monetary policy that led those very high interest rates in 1979, 1980. And he said that this jump in M1 would lead to higher inflation. It didn't. Inflation stayed moderate in the USA for several more years, and Milton Friedman had egg on his face. He was completely wrong. And this episode was one reason why monetarism lost credibility in the American public debate. Let's then look more recently at what's happened in the last decade. Let's look at what happened in 2008, 2009. What we all know is that inflation has been lower in the last 20 years than in the 1970s, 1980s. So what we'd expect is that we'd see lower growth rates of M1 in the last 20 years than in the previous 20 years. But that's not what we see. We see these very high growth rates of M1, 1 or 2 points about a decade ago. Why? The answer is that as the Great Recession hit in late 2008 and early 2009, the Federal Reserve slashed interest rates. That then had exactly the same effect as we saw in 1983. Suddenly, time deposits, savings deposits were less attractive than before. Interest rates actually came down to virtually nothing. And so there was this shift within M3, within broad money, towards M1, which soared. Look at these numbers. It actually went up 3-month annualized rate in early 2009, I think that was, of almost 50%. Look, this was just at the start of the Great Recession. If you were to say from this that M1 gives you a lead on the economy, you would say, heavens, M1 is surging. We're going to have a boom. Could not be more wrong. The reason for the surge in M1 was the change in the relative attractiveness of different types of money within the all-inclusive measure. Okay. So you can see if you'd taken the jump in M1 as a forecasting tool, you'd have been quite wrong. It was utterly and totally misleading. Can I just say before I finish on this front that in early 2009 and carrying on through 2009, many monetarist economists in America did forecast rising inflation, including, by the way, Alan Greenspan, and including, for example, Alan Meltzer, who wrote a very well-known and important history of the Federal Reserve. They said, look at M1, look at the monetary base, M0, and they then took it that this foreshadowed an acceleration in, I don't know, something or other, and then there was going to be more inflation. They were completely wrong. The last decade has been a period of very low inflation. Inflation didn't take off, hasn't really taken off at all since, but insofar it has recovered, it was years later. So that is the main reason that I never look at M1. But there's another reason, a second reason, which is that, I look at money because it's part of portfolios. And what investors are doing is balancing their money assets against their non-money assets. If you're running an equity fund, you've got so much cash, you must decide what your cash ratio is going to be. Normally it's very low, but it's what your cash ratio is relative to the equities you've got. Similarly for a bond investor, similarly for a real estate investor. You've got to make a decision all the time about your cash balance against your invested assets. Now, what measure of money do you use? Look, do you use, this stuff? Do you use M0? That'd be ridiculous. Only gangsters buy houses with notes and coin, and they only do that if they're breaking money laundering legislation and so on. Nobody serious buys capital assets with M0 or M1. M0 and M1 are irrelevant to any assessment of the prospect for asset prices. So we must always, when we're thinking about the relationship between money and national wealth and national income, we must always use an all-inclusive measure of money. You can see from this chart that sometimes people say that Milton Friedman's favourite measure of money was M2. Friedman had this rather sad sort of flirtation with M1 in the early 80s, but most of his career he was indeed a supporter of broad money. And M2 is currently the main measure of broad money in the USA. In my view, it's become very misleading, but still, well, let's have a look at it in the last crisis. We know that the downturn was kind of started early 2008, carried on sort of into 2009. Final sales were still weak through even to 2010. M2 just doesn't work at all. Again, it blipped up, and M1 blipped up. Useless. Okay, so that's why in the discussion of what's going on in America at the moment, I look at M3. M3, by the way, the numbers were prepared not by the Federal Reserve, but by a separate advisory company, Shadow Government Statistics. You can see, if you look at the behavior of M3 in the Great Recession period, that it sort of works. It doesn't work as well as it should do, frankly. It didn't give much leading time beforehand. It stayed going down after the end of the US recession, although, as I said, final sales were still leaking even through into 2010. But it sort of worked. It's okay. It's not what to say. But now at the moment, let's now move back to the present. Let's think about what's currently going on to USM3, and let's set it in the context of the last 10 or 15 years. This is a chart again of the annual growth rate and the annualized 3-month rate of change. You can see at the start of this chart, the end of the Great Recession period. Collapse, and so on. Then recovers, stabilizes, goes sideways. Yeah, it's been a very stable period for the US economy, all right? You know, what everyone says about the last Fed chairmanship, my word, didn't Yellen deliver some wonderful numbers? Just beautiful numbers, okay? Very steady growth of nominal GDP, beautiful. Then at the end, we get what I showed you at the start, the first chart, which is turning downwards. You might say, you know, there have been other periods like this in the last decade, so why are you so worried? And I want to give my 2 reasons for being concerned looking ahead from here into the rest of 2018. The first problem is that the Federal Reserve has said that it's going to be selling off assets for the rest of this year. Look, if somebody sells me an asset, then I've got to buy the asset, my bank deposit goes down. Now, normally it goes into somebody else's bank deposit and the money stays in the system, but not if I make a payment to the Federal Reserve. The Federal Reserve is a bank. In fact, no one make a payment to my bank, which then makes payment from its cash reserves to the Fed. So the bank's cash reserves go down, my bank deposit goes down, and the Fed's own balance sheet contracts in size, which is what they want to do as part of what they call policy normalization. The Fed's asset sales will reduce the quantity of money to the extent that the sales are to genuine non-bank private sector agents. And I think it's quite plausible that in practice, say, a half of them are going to be to genuine non-bank private sector agents. Some of this, of course, is because the assets that are being run off are so-called asset-backed securities, where there are redemptions by the private sector issuers of these securities. You know, when a company redeems its bond, it pays some money from its bank account to the bondholder, and its bank deposit goes down. Money is destroyed by that process if the sale is to the Federal Reserve. Okay. This point is not controversial. I've looked up, done some research. There's RBC Capital Markets done some numbers on this. They think that the decline in bank deposits in America in 2018 will be about $375 billion, and next year $410 billion on current policies. Now look, USM3 is about 18.5 trillion, 18,500 billion. So 375 billion is 2%. And what was the last figure for the growth rate of USM3, 3-month annualized, was 2%. In other words, what we're heading towards is a period in which the growth of broad money in the USA might be between, say, 0 and 3%, almost nothing. There'll be a bit of inflation for a bit. Very, very low growth, perhaps even contractions of real money. Okay. That's not good for asset prices. It's not good for economic activity. It may be, in fact, what the Fed wants, because they want to ease up the labour market. I think is too tight. They may want to dampen down inflation pressures. At any rate, I put it to you that this is somewhat worrying for the US economy later on this year. The second point I want to make here is that this may sound a bit odd, but in my view, the evidence that money is important to US economic activity, real money, economic activity in the short run, in the long run, nominal money matters to inflation, the evidence is overwhelming. I can produce dozens of charts and so on showing this is true. Always, please, always all-inclusive money, M3 that means. That's, by the way, in both Britain and the Eurozone these days, I think that's pretty much accepted in central banking circles. In the Federal Reserve, it isn't. They stopped preparing M3 numbers in 2006. What that means is they're not looking at the implications of what they call this policy normalization, these asset sales for the growth of broad money. They don't think it matters. Now, in practice, When the numbers start to change, yes, they'll adjust policy, and amazing, they may reduce the size of the asset sales. That's later on this year, but watch how things, evolve. I think I want to just conclude by saying that in the last, 10, 20 years, central bank research has been very much about what's happening in labour markets, and then unemployment numbers, the rate of change of wages analysis, so-called Phillips curve, expectations augmented Phillips curve, all sorts of technical things I don't want to go to at the moment. It's been very much about these kind of things, not about money, not about the banking system, not about financial markets, not about asset prices. Now, anybody who knows something about any business, how business cycles work, knows that the labour market lags the economy, and the banking system and asset markets lead the economy. It fits with what I'm saying, that the first few months of 2018 have seen rather poor performance in the stock market. Even if we look at the labour market in the USA, it just simply isn't true that there is at the moment any period of, or any obvious signs of extreme tightness. You can see from this that if we look at employment relative to the US population, employment as a percent of population of working age, it hasn't actually returned to the average in the last 30 years since the Great Recession. It still is somewhat beneath that. So my core message is that on present policies, significant slowdown in US broad money is underway, and this means a period of beneath trend growth later in 2018 and early 2019. The good side of this is that the inflation outcomes next year will be very good too. Thank you.